A tax-advantaged investment account that helps you save for retirement is known as an individual retirement account, IRA. You can open an IRA through a bank, a robo-advisor, or a broker. To contribute to an IRA, you must have earned income. There are annual contribution limits to an IRA that vary depending on the type of IRA. An IRA has the advantage of growing your money tax-free or tax-deferred, depending on the type of IRA you have. We're talking about what the IRS refers to as individual retirement arrangements. IRAs have yearly contribution limits, and you can contribute up to the IRS maximum amount each year. What is the purpose of an IRA? Anyone who earns a living can start an IRA to save for retirement. Employees having a 401k plan through their employer, a non-working spouse whose partner earns an income, or even a minor earning their own money are all eligible. A bank, broker, or robo-advisor can start an IRA, and the monies deposited can be invested in stocks, bonds, exchange-traded funds, or other assets. The growth of your account balance over time is determined by how you invest and how much you contribute to the IRA. Individual IRAs include the Standard IRA and Roth IRA, as well as the SEP IRA and Simple IRA for business owners and self-employed individuals. While you can have many IRAs, keep in mind that each account has a single yearly contribution maximum. There are also withdrawal rules because the funds are intended to be used during retirement. If you withdraw money before the age of 59.5, you may incur a 10% penalty and a tax charge, unless you qualify for an exception. Here are 5 common types of IRAs, along with an explanation of each. 1. Traditional Individual Retirement Account. Traditional IRA contributions are frequently tax-deductible. Contributing $3,000 to a typical IRA, for example, could lower your taxable income by $3,000. Traditional IRA withdrawals in retirement, on the other hand, are taxable as ordinary income. If you are married and have a retirement plan at work, the amount of your conventional IRA contribution that you can deduct is decreased, and finally eliminated, if you reach a particular income level. Contributions can still be made, but they will not be tax-deductible. If you and your spouse do not have workplace retirement plans, you can deduct your IRA contribution regardless of your income. 2. IRA Roth. Contributions to Roth IRAs are not tax-deductible, but withdrawals are tax-free, and investment profits are not taxed. According to certified financial advisor Matt Aaron, founder of Washington, D.C.-based Lux Wealth Planning, an affiliate of Northwestern Mutual, it's an appealing alternative for investors who have a long time before retirement. The question is whether you prefer to pay your taxes now or later. I'd rather pay taxes now, Aaron says. According to Aaron, Roth IRAs can assist you in fighting inflation because money loses value over time. He compares a Roth IRA to paying taxes on the seed rather than the harvest. I don't have a crystal ball, and I can never predict what will happen in the future, but if taxes rise and you take that money out in the future, you can potentially reduce the taxes you pay. 3. SEP IRA. SEP IRAs are typically IRAs for self-employed individuals or small business owners with few or no workers. Contributions are tax-deductible, much as traditional IRAs. Investments grow tax-deferred until disbursements are taxed as income at retirement. Contributions are restricted in 2023 to 25% of compensation or $66,000, whichever is less. SEP IRAs do not allow for catch-up contributions after the age of 50. If business owners contribute for themselves, SEP IRAs demand proportional contributions for each eligible employee. 4. Simple IRA. Simple IRAs, Savings Incentive Match Plan for employees' individual retirement accounts, are designed for companies with less than 100 employees. Contributions are tax-deductible, much as traditional IRAs. Until retirement, investments grow tax-deferred until disbursements are taxed as income. Employee contribution limits for a simple IRA are $15,000 per year for people under the age of 50 in 2023. In 2023, anyone over the age of 50 can pay an additional $3,500 catch-up contribution. Employer contributions are required. 5. IRA Rollover. A rollover IRA is not a specific form of IRA account, but rather the process of transferring qualifying assets from an employer-sponsored plan, such as a 401k, into an IRA. People do this when they change jobs so that they may keep all of their money in one location. Why should you invest in an IRA? An important advantage of an IRA is that the money you invest in one grows tax-free or tax-deferred, depending on the form of IRA you select. If you contribute to a traditional IRA, you will receive a tax deduction in the year you make the contribution. You will then pay taxes when you collect distributions in retirement. There is no immediate tax deduction or benefit from contributing to a Roth IRA, but distributions in retirement are tax-free. However, tax breaks are not the only advantage. The main advantage of an IRA is that you have more investment options and choices. IRA adds. Employer-sponsored 401k plans may have restricted investment options or may not allow you to choose your own. In addition, a 401k or pension might not provide you with enough money in retirement. Contributing to an IRA can provide you with more investment alternatives, better retirement income, and, yes, tax breaks. One disadvantage of IRAs is that annual contributions are limited. In 2023, you can contribute $22,500 to a 401k and take advantage of an employer match if one is available. IRA contribution limits are significantly lower. In 2023, your total IRA contribution limit is $6,500, or $7,500 if you're 50 or older. While you can have multiple IRAs and contribute to them all in the same year, the contribution limit is a combined limit. How much of your conventional IRA contributions are tax-deductible? It is determined by your income. Traditional IRA deductions have income limits, but only if you or your spouse have a workplace retirement plan. In general, you can begin taking distributions from a regular IRA at the age of 59.5. If you withdraw money before then, you may be subject to a 10% penalty, with some exceptions. When you reach a particular age 73 in 2023, you must begin taking mandatory minimum distributions. Roths have income limits and contributions are phased at certain income levels. Brokers and robo-advisors are two common ways to start an IRA. If you prefer to choose your own assets, an online broker can be a suitable option. Consider a robo-advisor if you need assistance managing your retirement account. This is a service that selects low-cost and risk-appropriate assets for you. What types of retirement accounts do you have set up? Leave a comment below about your particular arrangement. Take care and remember that your money matters.